Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth. Yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
Welcome back, everybody, to another episode of Rebel Wisdom. I'm Julian here with B. We got a super scary topic for you guys today. We're gonna talk about debt. I feel like has a super negative connotation. I was being kind of joking saying that because it is perceived as, I don't know, B. What do you? I feel like it's perceived as mostly bad when it's not always the case. But
Yeah, dude. No, I'm excited for this episode too because we talk about a lot of, I guess, controversial stuff in a sense that not like current day news controversy,
right,
but like from growing up, the old wisdom of controversy of the things that you're taught as a kid,
right,
and if you kind of look into it, you're like, oh shoot, like it actually might not be the case, from what you learned in elementary school or your household. And I think the topic of debt definitely leads to, if you put a top three biggest controversies of money or things that you learn in school, like debt is like definitely top three. And yeah, it's like, I think you're taught at maybe from your parents or from school or from whatever TikTok or whatever, these influencers, most of them say, hey, debt is bad, right? And I don't think that's a bad place to start because if you use debt the wrong way, it can absolutely destroy you. And there's so many more cons to debt, not just on the money side. Like there's a lot of psychological and emotional downside as well. But then it's interesting because, you're taught to not use debt. And I was pretty much taught the same thing growing up from my parents. And I don't think they were extreme as, hey, like I'm going to cut up all my credit cards type stuff. But they always told me debt was bad. And I mean, I think that they were using debt my entire life, pretty much, I think, from what I kind of observed. And even though we know it's bad, it's like a normal thing to do, if that makes sense.
what's that
Like
to do?
it's very to go into debt.
Oh yeah,
Very normal, okay thing to do. Like credit card loan, a credit card debt is like normalized.
yeah,
And for a car, most of the cars
yeah.
you can just buy 0% down on whatever, and then you have a car payment. And especially for a house,
Yeah.
there's a very, very, very small percentage of people that actually buy the house cash, or
Yep.
at least, maybe they didn't buy it cash, but they paid it off somewhere along the way of 30-year loan. And so I think this is very interesting, very exciting topic, definitely for the Rebel Wisdom podcast.
Yes, sir. It is. I can't pinpoint when I first started hearing about debt or even who I heard it from. Like you said, household, school, just around and just around. But I know the talk about it was, try to avoid it. Certainly try to minimize, if not eliminate it. Debt's bad, debt's bad, debt's bad. And kind of going off what you were saying, if leveraged correctly, like a lot of things, it's not necessarily bad. And I'm thinking as I was listening to you talk, if I were to reference multiple other episodes we've done, like a lot of times we come across things and the question is like, is it inherently bad? We did an episode where we were talking about, I think, power is like inherently bad. And came to the conclusion, not really, but there's negative, it might, in abundance or whatever, it might cause people to act bad. Or if used wrongly, power may be bad. But like power in itself, I'm not talking about like electrical power, but like an individual having influence in the way of power, like that inherently isn't bad. Like is just debt, just the concept of debt, like is debt bad? I don't know. Maybe we should define debt. So I think debt, this isn't a non-official definition. I just think of like owing money, whether it's to a person, to an institution, organization, bank, whatever. Just owe money. I don't know. I'm trying to think. I don't think that's like necessarily bad, inherently bad, but I think a better question is is debt necessary? Like, can a reasonable person living a average reasonable life, like, can you go your whole life and avoid debt? Like you said, if you're buying cars, houses, very few, as you stated, are just gonna outright buy a house. Or sure, you can save up and buy a car, cash or whatever, but that's not the majority. I think debt is somewhat normal, dare I say, unavoidable. But the more important thing is, yeah, how do we go about it? How do we shape our mindset around it, and then how do we attack it? I don't with consistent payments, whatever. We'll dive into all that, but yeah, I don't think I'd say debt in itself is bad. And I think a perfect entrance to this conversation is credit cards, which even just briefly talking about it, you already mentioned credit cards and what you were saying, because when I think of debt, that's the thing at the forefront of my mind. Like most adults have credit cards. Like some people maybe don't have a mortgage, maybe don't have a car payment, but most people, again, adults have credit cards. And with that, subsequently comes credit card debt. And I know that's a huge part of the US's national debt is like credit card debt is a huge chunk. And to that point, a quick story, like, so my sister's out of college, right? And I still don't think, like, one of my things was even when she was going through college, I was like, I really wanted her to get uh a credit card. Her mom was like, no, like, nah, not yet. And she's like very responsible. Like, she doesn't do a
Mhm.
lot, especially compared to like her age group. Like, she's somewhat frugal. And they just didn't want her to get a credit card. And I'm like, she can get something basic just to establish a line of credit. Just she didn't even have to use it a lot. And I still don't know. She's been out of college a couple years now. I still don't think she has a credit card. I honestly don't know, but and there's just kind of that fear of like her establishing debt or acquiring this debt that is insurmountable that she can't pay off. And it's that age old theory surrounding debt where it's just like you don't get a credit card till you absolutely need it, or avoid debt at all costs. That I don't agree with.
What do you know the number off the top of your head? How much credit card that there is in the United States?
So you're just saying,
Uh,
like, how much credit
yeah,
card
yeah.
debt in general? I wouldn't even trillions, I would say.
I mean, you got the I think you got the digit right or
Whatever.
I don't know
Suff
unit.
yeah,
Unit is it a unit?
I don't know. Suffix? Unit? I don't have no, but I would say, yeah, probably low trillions.
So it says as of November 2024, Americans owe a record of 1.17 or 1.17 trillion dollars in credit card debt.
Okay, I was gonna say like
So
true. Okay.
yeah, they'll definitely cross. It was around the time we did a credit card episode before,
Yeah.
which was episode 14, and that was around the time I saw the like major news across a lot of news outlets. It was like U.S. debt crossed the U.S. credit card debt
Go.
crossed $1 trillion, and I was like, oh crap, like let's talk about it. And yeah, it's one of I feel like you said it perfectly. It's normalized. Like so many people have it up to this point. It's like
Yeah.
it's okay to have it, right? And I talked about it previously too. In order to be doing average financially, you can say, it's like they say, oh, if you have a credit card balance of $4,000 or less, you're doing good. So with that definition, if you have debt of $1,000, you're still doing good,
Right.
which is kind of weird to me because, like, I would assume if you're doing good, you wouldn't have any credit card balance, right? And yeah, it's, unfortunately, I've never been in a place where I needed to incur credit card debt, but I would imagine that's so scary just because, like, it's a freaking rabbit hole.
Yeah.
The APR is like 20
Yeah.
plus percent. And, I think it's good. I've seen some movement at the government level where they want to cap the interest rate on a credit card. I don't know if that's going to actually go through or not,
Yeah.
but it once like you get something like 20 something percent interest and you're just paying back the interest just to keep up. On top of that, you got to
Right, obviously.
tackle the principal amount.
Right.
And
Right. Yeah. No, for sure. And then so this is like getting into the weeds, maybe some pros and cons. But certainly a credit card is good, right? You can, fundamentally just like use it to buy now, pay later. But I think where it gets people is when you, I don't know,
Pay later.
default. Yeah, like yeah, when you pay later or that interest rate really starts to kick in. Or but then I feel like the conversation shifts to like the fact that you have that debt on that line of credit isn't bad, but your ability to pay it or your management of money to allow yourself to pay it or the overuse of the credit card where now you're again incurring these large amounts of debts. I feel like those are the heart of the issues, not that you now owe the money. So that's why it's such an interesting conversation to me. Well, literally, conversation within the conversation, credit cards specifically, because yeah, I would encourage if somebody like my dad recently, right, way older than me, he recently in the last couple years got a credit card and he didn't have one for years, and just through discussions and things that he's trying to do or he and I are trying to do, like he got a credit card, but it's almost like that refusal to have their credit card debt. And he's good. He pays it off every time. Like he's not using it for anything crazy. Yeah, I think it's like the management of the card vice the just the debt.
Yeah, like I said, we talked about the inherently good or bad.
Yeah.
Credit card isn't inherently bad.
Yeah.
It's a tool, so if anything, I would put in the good category because it allows you to give you the option, and if used properly, it does give you more benefits than non-benefits or disadvantages. And I think it's so interesting because I think for majority of people, you learn money, finances, personal finances through your family or your parents or the mentor that you had or something like that. And I think money is one of those things that, you know, I feel like in the wisdom piece of money, you can surpass your parents relatively quickly compared to other things. Like
Ooh, I like where we're going with this.
when talking about like a career, right? Like you're just a fresh college grad, high school grad, like you're just starting your career. Like, of course, your parents gonna have much more experience in a lot of stuff, like cooking, driving. Like of course, they're gonna have more experience. And with money side, yes, they could have more experience, but that doesn't mean that they're using it properly. Like I would say like surpassed my like parents' level of knowledge of personal finance when I was like 23. And they just like they've always been high earners, but the personal finance piece wasn't that great from what I'm hearing.
Mm,
And yeah, and it's easy to get ahead because if your parents are in credit card debt, you just don't have to be in credit card debt, and now you're ahead of them, right?
yeah.
And
Okay.
but yeah,
Yeah.
I'm just trying to. With that being, I mean, it's like a hot. I don't know the actual um, conclusion I'm trying to make, but it's one of those things that you can read a couple of books on personal finance and you will literally know more than the average person about personal finance. And
Yeah.
there's not a right or a wrong way of the approach to personal finance. Like some people go the Dave Ramsey route where they say, hey, no debt, no consumer debt, maybe a 15-year mortgage could be
Yeah.
in in the store for you if you meet a lot of the wickets. But then you meet or you read about stuff like, or no, I read Rich Dad Poor Dad. That's one of my favorite books that got me started all on this financial journey, and that book has literally changed my life for the better by 1,000%. But the author, he talks about debt like you should be using debt for everything. I'm not
Mm,
quoting him, but that's the stuff that he talks about, and it's polar opposites of Dave Ramsey and Robert Kiyosaki on the thought of debt. And a lot of people are going to say, like, oh, that's right, that's wrong. There's not right or wrong.
yeah.
Just like every other topic that we talk about on any subject matter, nothing of something that leans 100% this way or that way
Right.
is correct.
Right.
So within the debt conversation, again, I don't think 100% is good. Like, I'd be scared to live life if I had everything on debt.
Oh God.
But if I actually went zero debt, like I wouldn't be at the place that I would be at today. And I'm just not gonna. I don't want that. Like obviously, I want to be better than where I would be today, right?
Right. Of
And
course.
then again, it's not. I mean, at the same time, it's like a double-edged sword. You use it improperly, and you go in the wrong direction very, very, very quickly. Whereas if you use it correctly, it's harder to see the results, I guess. It's
Yeah.
I think about it like lifting. It's gonna take months and months and months of hard work to get good results. You getting stronger, but as soon as you don't work out for like a week, like, are you gonna start working out again? Like, hell no, you're not. Right? You're definitely gonna skip for the second week. You're gonna skip for the third week. And okay, 6 months goes by. You go back in the gym. You're like pathetically weaker than where you were before.
Yeah. There's so many ways to take this conversation off of what you just said. I guess a natural progression would be like some pros or cons. First off, early on what you said use it as a tool, which just as a joke made me think of like an actual tool, like a hammer. Like a hammer is not bad. I mean, you could use it to kill someone, like that's bad, but like, or you can use it to like build a house. Like it's that's a literal tool, but like that is figuratively in this conversation could be a tool. So I don't know. I just made me think about that. But on the topic of credit cards, was credit card and debt. I just want to give because we keep saying like if used right, like some examples, and you kind of um give a piece of your testament on the debt. How you said you wouldn't be where you are, at least financially, if you haven't leveraged debt. Or probably did your research about debt or learned about debt in the ways that you did. And one probably more surface level way for debt or credit cards to show a positive like use case is credit score, which a lot of people care about. I think some people probably care about too much. I mean, credit score is I think it's cool as like one little metric to see how you are, but I think some people like fixate on credit score, but that's my personal opinion. Um, but you do objectively need a decent credit score. There's literal categories, maybe good. I don't quote me on like low 600s or maybe high 500s to low 700s. I don't know, but you do objectively need a good credit score for certain things, right? They'll check your credit score, and having a or multiple credit cards could aid your credit score, or having some debt and showing that you're able to pay it off timely over a period of time could help your credit score. Opening, lines of credit could help your credit score. So there are tangible reasons why credit cards and or debt and how you pay it off like act positively. And then you can use that. That'll help you get cars. That'll help you get houses. That'll help you open a business or start a business, like, etc. So just within this conversation, I wanted to start giving tangible reasons, and you can probably speak to, maybe how you've leveraged debt or one example in your life, and, to elaborate on why it can be good.
Yeah, no, I got a few examples, and I say I say it's a good, I mean, proper use of debt because it worked out, but
Like, so
some of
proper
them,
use.
I mean, I'll let you know my actual insights on it, but basically one of the examples I'll give a few, okay?
Yeah.
One of them is during COVID, I'd been investing in the stock market for about maybe 2 years at that point. So I knew a decent amount. I study a lot on the books, no, financial books about stocks, stock market, how to evaluate. I I was learning a lot.
Mm-hmm.
And when I saw the COVID like crash happening during March of 2020, I was like, this is I was also naive because I was underway out to sea when I was in the Navy. So I didn't really understand what COVID was because we didn't have COVID on the ship. And we didn't even come back. Like we left in like January of 2020. We didn't even come back to like September of that year. So until that, I just heard of the COVID thing. I was like, what, it's like
Didn't
a
feel
made
it,
up
yeah.
thing that you see on the news. Yes.
Right.
So that was my thought about it. So when the stock market crashed, I'm like, by any valuation method you can use, stock market was undervalued by a
Mm-hmm.
crazy amount. And at the time I also didn't understand a lot of risks that, if I knew what I know today, I probably wouldn't have done what I done. But when I saw that crash, I'm like, this is not happening. There's no way. This is so illogical. It doesn't make sense. I went to my bank or like on my app and I took out a 50K loan and I just dumped it in the stock market.
That's crazy.
And literally it rebounded as soon as I put it in, and you can see the graph that, you
I love it.
search the COVID graph It literally crashes down and crashes back up. It was the fastest like crash ever
Mhm.
recorded in history, right? So obviously, I mean, I made a lot of money with that, and then later on, like literally within like 6 months, I realized that was a very, very, very dumb move, and I pulled out the money. I pulled out like 40 something K from the stock market, and I just paid it off,
Mhm.
and that's called gambling,
Yeah.
and I won the gamble.
Right.
But like actual smart, I think in this conversation, it's very important to classify good debt versus bad debt.
Yes.
And I'm going to take the definitions from Robert Kiyosaki because, like, for example, like Dave
Boy,
Ramsey, he doesn't believe in good debt or bad debt. All debt's bad,
bad for him, right?
right?
Okay.
Right. But then Robert Kiyosaki's definition of good debt versus bad debt, I think it fits the common narrative amongst the people that know how to use debt. He says if that debt, by having that debt, you make money, then that's a good debt.
Mhm.
If it doesn't, without exception, it's bad debt. For example,
Simple, easy, yes.
all consumer debt is bad debt.
Bad debt.
So that would be like credit card debt, car loan, student loans, an iffy one to me, but then we'll say student loans because having a student loan doesn't necessarily mean that you can make more money,
Directly.
right? Because
Indirectly.
directly, because
Yeah.
yes, but
Yeah.
so those are all bad debts. And the only good debt that you can say is like, okay, maybe a couple. We can say business
Business,
debt
yeah.
could be good because you're using capital to grow your company as long as it works, right?
True.
And then also on the real estate side, like I own a few rental properties and I have debt on them. And as long as you're making more from rent than the debt payment that you owe, like that's making you money, right? Like if you didn't get that debt, you wouldn't own
Right.
that house. Therefore, you wouldn't make money. But by having that debt, you have access to a house that generates income and therefore it makes you money. And then, so there's a lot of skills involved to do that. It's very hard post COVID just to buy a house 20% down and expect a lot of cash flow. Like that just doesn't happen anymore. You have to get very creative with it. But those are what's generally known as good debt. So yeah, I mean, I'm I'm against consumer debt, and I don't think anyone is for consumer debt. Even Robert
Right.
feels like people say, okay, debt's good, debt's bad. I have never heard anyone say, hey, go buy, those Louis Vuitton loafers that cost $1,000 and go put it on your credit card. I've never heard that, right? Like we can, as a community, agree that's a dumb move, and I think debt has such a bad connotation is because people do that often. I'm not talking about just Gucci or Louis Vuitton loafers, but for a lot of stuff, vacation, tech gadgets, new phone, new car, like it's the payments are racking up.
Right.
And then, not a lot of people know enough about the good debt. And so I'm gonna go on a tangent because I'm very passionate about that topic. Um, and especially for a house, right? Because so we can say, hey, good debt, bad debt is consumer debt. We kind of all agree as a community that bad debt is bad, right? But within the good debt, there's a lot of conversations too. And I often browse around a lot of Reddit pages and I read about people's thoughts. And a lot of the things that I see and hear is they say, hey, here, I'll pull up the actual calculations for you.
Dude, it's funny. While you're pulling that up, quick story that this happened this past week. It's going to remain very anonymous, but I have a friend that I was talking to, and they were talking to me about one of their friends that hit him up to borrow some money, who was like $50, nothing crazy. But in that same conversation, like if we were looking on the phone, like you would barely have to scroll. They were talking about like going on a trip out of state like the next week and like asking if they wanted to go on a trip, but then ask like borrow $50. And again, it just comes down to mindset and but like I feel like that's typical. You said vacation, like consumer consumers. I don't even know. I was just they told me that quick story, and I was like, that's a microcosm of what could be happening like at large. It's kind of an extreme example, but to me that's just wild and falls back on the mindset piece. But anyways, continue.
Yeah. How
I want
they just don't at that point the priorities isn't even
right. That, exactly.
Yeah. So back on the housing debt topic. So let's say this is real numbers. Let's say you buy a house, and for the for the easy math, we'll say the loan amount is $500,000,
Right.
and it's a 0% loan program. We'll do the 30-year term,
Yep.
and then we'll do
Standard.
interest rate of 6.5%, which is what I'm typically seeing around today. It could change by the time the episode airs, but bear with me on the calculations. So your monthly payment's going to be $3,160 a month. Okay, got it. But when you pay for 30 years, which is a total of 360 payments, you end up paying $1 million, $1,000,044.
Exactly.
And they say,
Is
like, look, even though a mortgage is bad because you only took out a $500K, but you end up paying $1 million for it, right? But then do the math on if your house appreciated at 4%, right? Here, I'll do the math.
yeah, I'm like where you going with this.
So we'll do 500,000 after 30 years, and we'll do 4%, and then we don't add any money after, right? So with that calculation, your expected house value, should be about $1.6 million.
Yeah.
So you only paid 1.1, but then your value is 1.6 after.
Mm-hmm.
So it's not about how much you have to end up paying. As long as the growth is greater than the interest that you're paying, like that's making money, right?
Right.
And a lot of people get it confused too. As they say, oh, but the loan percentage was interest rate was 6.5%, and the housing in this scenario, the housing return was 4%, right? So 6.5 minus 4, you're losing 2.5%, but that's not necessarily how math works. Like loan payments are on, as you make payments, your principal goes down every month, right?
Yeah.
So even though your payment's still the same, you're paying more and more and more every month to principal and less on interest.
Yeah.
Right? Whereas your housing payment or your house value, if it goes up 4%, it goes up from 500K, right? But next year, it goes up 4% from the value of after you grew 4% in the first year.
Mm-hmm. It's like
So it's all compounded. So while your interest payment decreases as you pay longer, your housing value goes up more and more with each 4% that's gained. So, you can do the math, you can see it for yourself. That's why even if you have a higher interest rate than the growth rate of your house, let's say mortgage, for example, like you do end up making money from it. And then, I think you heard, everyone has heard, the easiest for sure way to make money is owning your house, right? For a long period of time, regardless of you have mortgage or not. Like it'll be better not to have a mortgage,
obviously,
but then it comes with opportunity costs, right? So yeah, I just wanted to. I don't want to say I want to settle the housing argument, because at the end of the day, it's an argument, right? I'm not right, you're not right. I'm not wrong, you're not wrong. It's just having a conversation, different way to look at it. So that's that on housing.
Yeah.
What do you want to talk about?
Yes. And that, ladies and gentlemen, is how you can leverage some debt. Yeah, it's funny. I feel like if you listen to us long enough, there's certainly threads of like pro real estate. We talk about mindset often. But these are the reasons why. And those deep dives, I feel like that was very good. And thank you for breaking down the math. Because it needs to be highlighted in certain avenues. You might hear, oh, it's good or it's bad, but you don't necessarily get the why. And you just talked about you in that scenario. really just emphasize on, you buy a house, you live in it, it appreciates, while you live in, you pay off your mortgage, maybe you have it beyond that, ideally, and you sell it, and you'll capitalize on that appreciation. But not to mention, if you buy it and you rent it out, so it's appreciated over time. You'll have multiple renters over the years, but you could be cash flowing on it or whatever, and then that's just added benefit into the real estate with that on top of you if you were just to like buy it and live in it. So like B just gave one example, but there's even other ways in that one example of just real estate where you can capitalize. There's multiple ways to multiple property styles or management styles or types of property you can get and capitalize on. So I'm really just expanding on what you were saying, but no, dude, that was an awesome breakdown. And I'm trying to think. I don't know. I don't want to say the most notable way to leverage that. Maybe the most accessible, because you could also start a business and maybe grow that, I don't know, tenfold, or it could be more lucrative than real estate, but that's less tangible, I think, for maybe the everyday person than real estate, which is why I think it's such a fallback example for us. I mean, we both dabble in it, you more than I, but it's, I don't want to say super accessible. It's out of all the ways to probably make money, or especially in the debt conversation, I think it's the most prevalent. I don't know.
Yeah. I think, yeah, because if you know what you're doing, I feel like, yeah, you can leverage debt to make, 100x, 1000x on the business side, right? But then for a lot of people, like you said, for the everyday people, you have to be good at business as well. So people that take a business starter loan of some sort, and I mean, I think, I don't know, I've seen it on social media multiple times, but like Mark Cuban says, if you take a business loan as like a startup that you never done business before, like you're dumb, because the chances of your business surviving and thriving is very, very, very low. Instead, you can start a business without having debt, and then, at a certain point when you're ready to take on debt, you can. And don't take my word for it, because I mean, I have my real estate business, but it's not a traditional form of business, you could say. But yeah, like on the real estate side, yeah, it's like people are begging to take their money, right? Especially if you don't have consumer debt and you're ready to buy a house, you're like, soon as you apply for a mortgage, you have 100 people calling you a week about, hey, like, come, we can offer you a better rate, blah, 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 blah. And I mean, it's also government funded, or government backed. So there's a lot of capital available on that side too. And I do want to mention on the real estate side, it's interesting. Real estate is a very interesting asset class, I think, because you can apply for the small business loan, right? You can do a lot of that. Let's say you're trying to like, real estate is a form of arbitrage, right? Like you take on debt, you're trying to collect more monthly payment than you're trying to collect more rent than your mortgage payment.
Yeah.
And you're trying to gain the difference, right? That's a form of arbitrage. And if you try to do that in the stock market, for example, you go to the bank and say, hey, let me get 50. We'll say, let me get 500K. And they're gonna say, okay, what do you want to do with it?
Why?
They said, okay, but if person A says, oh, I want to buy a house, or they say, here you go. And person B, if they say, hey, I want to invest in the stock market. And historically, percentage wise, stock market returns much higher numbers than the real estate market, right? Real estate nationally is about 4%. Stock market over the last over 100 years, it's been about 10%. So you could argue, okay, like stocks, like you could argue stocks is a better asset class than real estate. But you go to, and then back to the bank, they would look at you crazy if they're like, oh, can I, like, what are you going to do with that 500K? It's like, oh, I'm going to take the money and invest it in stocks. It would be instant denial.
No.
Right? But then real estate, like, the bank says even for 0% down loans or 3.5 FHA loan, like 3% or like a 5% conventional loan, they're okay with you taking that large sums of money because it's backed by such a safe asset of real estate. That's a side note. We can go back to that conversation, but
I mean, it's all tied.
Yeah,
it's all tied into each other. And then when you start expanding on this a little bit more and you want to get um like purchase of bigger assets or the continual multiple real estate, like I feel like at some point, unless you're an anomaly, the 1%, maybe you're in a super high earning profession or inheritance, whatever, like you need these assets or this debt to get other to build upon or get other assets. So that's why I say like today, I wouldn't say today's in age, but it just for me, it all goes back to the point that debt isn't inherently bad. And then my second point or to support that is like if you know how to leverage debt. And you said something in while you were talking about, like if you know what you're doing, which is why I feel like this and a lot of other topics just start with the education piece. Because yeah, you're gonna I wouldn't say just go buy a house. I mean, like take out a loan, like don't compare loans. Go buy the first house, like don't compare markets and it just no, there needs to be some, like you said, I guess like you need to be business savvy to a degree, or there needs to be some like educational piece. But like even me, like I don't know. I mean, there's plenty of people that know way more than I do about real estate. But as long as you get the baseline knowledge, I would say you can enter the real estate game. Or same with debt. Like if you know the basic fundamentals, which wouldn't take that long with talking to people, shoot, you can go on YouTube, um, self-educate. I just don't let debt scare you away.
Yeah.
You
The
know what
peak. Yeah. The I want to tie the like scariness of debt, and I'm interested to hear your thoughts on it on what I'm about to ask. But I feel like a lot of the taboo topics that you're mostly majority of the time either not taught or taught at the household. Like like religion is usually a taboo topic, right? At the dinner table, with other people, for example. Politics is a taboo topic.
Yeah.
Money is a taboo topic.
Yeah.
And I think out of all those things, money brings on like a insecure feeling for the people that don't know how to use it properly.
Mm.
And within that conversation, we were talking about earlier about how you usually get taught finances and personal finance, economics from your parents. And then it's interesting because I mean, you have conversations about your parents now that
Yep.
you're an adult about money, right?
Yep.
And I feel like, at least for my parents and a lot of adults that I talk to about money, they are so insecure about the topic of money. It's very hard to either continue the conversation of money, or if the conversation continues, like it's very hard for them to be open-minded about money
Mm.
because it's something that they grew up with for 40 years, right?
Right.
Because I love talking about money,
Yeah.
right? And I want good financial aptitude for my friends and family, right?
Yeah, of
But
course.
then whenever I bring it up, they kind of shut down, and they also, I mean, they don't want to either talk about it. They
Yeah.
bring a lot of excuses, and yeah, what's been your experience?
I agree. So I'm gonna answer in different categories. Like the people I work with, like it'll come up, like you said, dinner table office. Usually those taboo topics don't come up too much. And I think just because they're in similar stages of life as me and we have similar backgrounds, like educationally and career-wise, because I mean that we're in the same career and we've all been in the same career, that it's actually not it's not like we can easily talk about it, like bounce ideas easily at work specifically. And I appreciate them for that. So that hasn't been my experience in that realm. My parents, it's it's somewhat easy. We've had some like different ideologies on certain things, which actually I want to circle back to. But me being able to bring it up, I wouldn't say it's hard. And then my friend group at large, it's kind of similar. Like I think I'm just lucky though. Like they also are like pretty interested in money because like you, like I
Mhm.
like talking about it, and they're just trying to do different things. So we have like group texts where we can. I can literally pull up my phone right now. One of the group texts I'm in is called. It's like it's titled stock something. It's like a stock group chat. It's called Stock Market in Shambles because when they made it, like the stock market was really bad, and then
Oh, okay.
they actually changed the name like recently when the stock market went up. But it was like a joke. But it started about like a whole bunch of people interested in stocks, and that's like the main topic of conversation in that thread. So personally, I almost can't relate as much. And then anybody outside of there, I just don't bring up money too much. But if I
Yeah.
were to, I know it'd be kind of like or it wouldn't want to talk about it, or just find ways to like disagree from it. I've had that a couple times, but I think you've experienced that more than me. But most of the people I would like, I just naturally like talk about money with, it's we're able to open the door to those conversations, which I appreciate.
Yeah.
But I think what you articulated is the larger narrative, and I've actually heard people say like, oh, like maybe like don't talk about that, and it's like why? Like
Yeah, like what?
everybody has you need money to survive. That is a basic need in current society. Fact. So why would we not talk about it?
Yeah, that's very interesting. Like seriously, we talk about food, we talk about sleep.
We're not.
Like, why can we not talk about money all of a sudden, right? And, like,
Right.
I mean, I think it all comes from ego and insecurity of the topic around money because, people probably know that they don't know enough or they know that they're not doing financially well.
Which is fine. I mean, yeah.
That's what I'm saying. But then by fostering these conversations, they can try to get better. But then we don't do that.
Right.
We just
Yeah.
kind of accept defeat and then we're trying to like get better in silence, all lonely. Whereas in any other field, you gotta collaborate to win. Right. And then
Preach,
like
brother.
at least for, I don't have kids yet, but I definitely do want to have kids. Money is gonna be a topic that we do not shy away from. Because there's a lot of ideologies of money, and like I said, there's certain things that are absolutely wrong, like consumer debt. We talked about it's wrong, but on the right category, there are just so many ways,
Yeah, man.
and I really wish that money becomes more of a less of a touchy subject that we can openly talk about with anyone, regardless of age, regardless of finance or economic status.
Yeah, for
And
sure.
yeah,
And it's funny on the money conversation and like bringing it up amongst people. I literally maybe a month ago, I have a cousin that's about 7, 8 years older than me. They have a young kid, and we were talking about something, or maybe I heard something recently. But I asked him straight up. I was like, dude, what have y'all opened any accounts for his sons for like pre college fund accounts, or it's just something I don't know about, but it's money related. I was like, I always hear about people opening up these accounts for kids, but I was like, what are some accounts you're familiar with and have you opened? He was like, yeah, we have I think it's called a 504. I don't know if it's 52. He mentioned that, but I don't know if that's the one he did. But yeah, right, let's take that for example, 529. And he was like, yeah, we've opened this one. These are the reasons why. Like, these are some of the ones we were shopping around on. And I was like, oh, appreciate that. This is something I know very little about. And he just shot me some quick facts on things like him and his wife had talked about. And it could be like that for anything. For like debt, like, oh yeah, I don't know. It was just to your point of like, I'll be quick to admit when I don't know something or misspeak or whatever, but I'm always usually like willing to talk about it, or like, hey, point me in the right direction, or a good book you read. We're always trying to, especially each other, like bounce ideas off each other. But even like in these discussions, throw out a good book. You said earlier Robert Kiyosaki. He has Rich Dad Poor Dad. I don't know if you have any counter perspective of Dave Ramsey, like any of his literature that you've read that we could throw out. I don't know if you have anything there. But yeah,
yeah, I read the because at first I was so against Dave Ramsey because math says one thing, right?
yeah,
But the more and more, like I guess I gained wisdom just through living life. Like more and more, I'm starting to understand Dave Ramsey.
interesting.
Because in the topic of debt, right? Like financially speaking, we talked a lot about numbers and how debt could be a positive thing.
Yes,
And I still stand by that because I'm more of a numbers guy than an emotional guy.
yes,
But with every dollar of debt that brings added risk, no matter what. Like there is a increased chance, it could be low, of something not going the right way with it.
Right. Sure.
Like for example, like I mean, a lot of the stuff is like bankruptcy scares, right? A lot of people get too much debt and you have to declare bankruptcy, and it ruins you, dude. It ruins you for like the next 7 years or however long it stays on your credit report. And at least on the like mortgage side, it's like the American dream to go buy a house. And
Basically.
there's a lot of emotional attachments to buying your house. Not just your first house, but especially for your first house. Like you're ready to buy finally, or you think you're ready to buy, you finally buy it, and you're excited. Oh, we're gonna grow. We're gonna grow. Raise beautiful families in this house. We're gonna have so many memories. And then one day you get fired and you can't make the mortgage payment anymore, and then the bank takes the house back.
Right.
Right? Like that's like emotionally draining, or just destroys you mentally. Right? And then, at least for me, I did have, like, looking back a year ago, right? This is January 2025. Looking back in April of 2025, or 2020, shoot, January of 2024, like I had student loans. I had two car loans. Yeah, I think those are the only thing I had. But in 2024, one of my goals was to just pay off everything that's not real estate. So I paid off my car, paid off my wife's car, and paid off my student loans. And the opportunity cost, like opportunity cost side, sure. Could I have made more money by paying off my car loan that was like at 4%? Absolutely, I could. But then the mental, I don't want to say mental clarity, but the ease on your mind,
Yeah, I was like,
ease on your, like, the ability, like the fact that I do not have to think about a car payment every month when I go to sleep. It gives me more than the extra 6%. Yeah, peace of mind than the extra 6% that I could, got in the stock market.
Right.
And that's the stuff that Dave Ramsey talks about more, which I just didn't understand previously from just looking at the numbers. And that is so freaking important. And, because I think I'm pretty deep in the real estate, communities, right? I guess, like, I'm not a big time investor, but I'm always trying to learn new things, and I'm always trying to go to real estate meetings and whatnot. But a lot of these gurus or people that talk about real estate is like, hey, debt, get more debt, get more properties, blah, 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 or whatever, right? But then it was very eye-opening when I read the book called Small and Mighty Investor by Chad Carson. And he preaches a lot about, once you're done with the growth phase of your real estate building, like, it's inevitable that you're going to incur debt during your growth phase. You have to, right? Or otherwise you're going to grow. You're not going to grow at all, or you're going to grow very slowly. And once you're done with the growth phase, it's okay to pay down debt. Like, one of the things that he talks about is, like, you can have 80% debt on one house, like a traditional rental property, and you can have another house that's completely paid off. So when you combine those two assets, you have a loan to value ratio of 40%, right? So, and if you're sitting at 40%, that's a very comfortable place to sit. Could stuff change like a 2008? Absolutely. Sure, it could. But that could happen with anything.
Right.
Like, you can buy a piece of gum and you can get fired and lose your limbs and not be able to work ever again. You can't afford that gum payment. Or like, anything could happen. So, like, it's very, those things are very unlikely, but it is better for you financially. You'll be in a better financial position in terms of allocating risk and managing risk.
Right.
Because you do need risk to, like, I guess risk sounds bad, but, like, you need to take a chance to win, right? If you just sit on the sidelines forever, are you going to win? I don't think so.
I mean, that's synonymous with having risk, though. Which,
right. I just didn't want to use the word risk. You got to take risk to win, yeah. Like I just never heard of a business owner or like a successful person. Like, yeah, never took any chances and just
Right.
came out on top.
Yeah.
It does, the risk doesn't have to be in form of debt, but it usually is. So yeah, that book was definitely eye opening, and I kind of thought about it because every real estate investor talks about, hey, start with a single family, go to a duplex, triplex, fourplex, and start buying those apartment complexes, start buying this, start paying. But no one ever talked to me about, hey, it's okay to settle down, it's okay to start paying off debt, and yeah, I'm sure. I'm just thinking, I'm pretty sure I'm gonna have a mortgage for a long period of my time, at least for the next 30 years. But I cannot imagine having like 5 rental properties with no debt.
How
Uh,
you couldn't? You financially couldn't. Like you would have to have the capital. Yeah. Like how would you
Yeah.
buy all those? And where? Yeah. Let's say again, you had a super high paying job or something. No, 100%. It's funny, like the peace of mind piece you anchored on the more the Dave Ramsey side, which I've read. Like I told you before, I know his general concept, but I haven't read any of his stuff or whatever. Um, but earlier you said there's multiple ways to go about this stuff. And in that scenario you said where you like, you paid off your cars, paid off your student loans. Yeah, that's great. I mean, you wouldn't have to, and you wouldn't have, like, even if you didn't do that, nobody could be like, oh, you were wrong. Like, you had the money to do that, you didn't pay it off wrong. No, it's not. There's different ways you could have leveraged that debt. Like I said, you could have put it in the stock market, you could have put it somewhere else and maybe made some return on that. But you pay some stuff off, and that's cool too. Maybe, yeah, like that's the unique thing about this is that there's multiple ways to do it. And it's, I don't know, I keep going back to like the debt management, I guess, like how you manage it. Now, are there like debt traps and people get caught in the cycle of uh I don't know, not paying off the debt? That's a different story. Or maybe even um I don't know, fall victim to like a predatory lender where you got like a really bad interest rate or something. Like there's a bunch of avenues we can do. There are absolutely cons to it too. I think we try to, and I think we do a good job in most of our conversations of highlighting both sides, even though we take a stand on one side, but you got to talk about both sides. So there's absolutely, um, debt traps you could fall into, and it could be a spiraling cycle if you find yourself on the wrong side of that. Yeah, I don't know. I start with the mindset, start with the education piece, and you can start small. It's not like your first purchase. Like you can have,
Yeah.
like you said, the credit card debt. Where you said 4,000, less than 4,000 is considered good standing. Yeah, don't feel like you gotta. You amass 300K of debt or it's nothing. Like no, you can start and work your way. Utilize as needed. Don't again the credit card debt. Like don't. Or you can overuse your credit carding. Yeah, of course you'll find yourself in a bad position. But again, it's controllable.
Yeah. That's why, like, at least for my strategy going forward, I had a long, deep conversation with my wife about this. You know, we own 5 units so far, and every single property we bought, I don't want to say zero down, but close to zero down for all of our properties. So in terms of like loan to value, it's pretty high. You know, we do make money on all of our rentals, so I guess from that side, it's definitely great. But there is always a risk, right? Like one of the risks that um, we encountered was I live in Phoenix, and during the summers of Phoenix, it I know it doesn't, but it seems like all travel just stops. So, we have a few houses on Airbnb and whatnot, and like you do great, you do great, you do great, you're raking in cash, and one day it just stops. You're like, oh my God, like what's going on? And like, am I doing something incorrectly?
Right.
And then redo your research on the Airbnb market. And it's like, oh my God, like none of these houses are getting booked. Right. And then like literally on 4 houses, no, not, it was three houses. I had to dish out my, um, like own capital into fund these bank
Yeah.
accounts because it didn't get to zero, but it was getting too close to the point I wasn't feeling comfortable.
Right.
And so after that point, like I was like, you know what? Like I'm gonna have a much cushier I guess, emergency fund for each of our houses. And then since then, we have not touched any of the real estate, um, I guess, profits that we made.
Yeah.
And then for all of our houses, we have 6 months of mortgage covered in that bank account alone. So in the worst case, I can withstand 6 months. And going forward, I was all about, hey, like, how can I buy more? How can I buy more? I can still afford it. And then just looking at the numbers, I'm okay putting in money into, I guess, savings, or, I put into stocks, and a little bit of crypto, but I'm putting in money into these investments that hopefully they grow over time, obviously. And when the time is right, I want to put down like 30-40% on a house down. So the mortgage payment is much lower.
No.
So that just increases, not sorry, it decreases the risk that I have on the property. So it makes, I don't want to say it makes me more money because you lose opportunity cost, but you kind of force a positive cash flow with the amount that you pay.
Right.
And
I like how you said that.
with that, I could definitely see myself stressing less about rentals.
Oh yeah.
Because at this point, like, I'm not in a place where I have to be extra stressed about money. Or like, I'm okay. Like, if I had an option between taking 12% and being a little bit more risky and you incur stress, or you take a solid 7% with, I don't want to say zero risk because there's no such thing,
Right.
but with much less risk and much easier to sleep at night, I will take the 7%. And I wasn't always like that. And
I was about to
I
say.
feel like the younger you are, I think you definitely do lean towards more risk, higher growth type of mentality.
You have more time to recover too.
But
Like that's kind of the time to
no,
do
right,
it.
yeah. And then it has also bit me in the butt, a couple times. It didn't turn out to be bad, but like
Right.
it got scary, so it just
Yeah.
just thinking about debt like that. Obviously, yeah.
Yeah. No risk, no reward. And I like how you kind of talked through your plan, like how you built up your emergency fund, respective of the different houses. Kind of because, and you were alluding to, like, if something happens, you have a plan to cover down, like, you and your wife, you guys alone. And that plan is what I was stressing, because that's what goes into, like, yeah, you have debt, but you also have a plan to attack it if something goes sideways. Because one of the I guess you say cons to debt is, you have a job that makes X amount of money, you're gonna make that, or you'll get a raise or higher or whatever. But what if something happens to that job, or for your rental properties? What if you don't have tenants? Like, what if the unexpected happens? That is one of the instances where debt, you had that steady income that you're using to tackle that debt. If that goes away, then that's where it gets dicey. But again, for you, in the example you gave, you had a contingency plan for that. And again, that's what I'm talking about, when like the mindset and just thinking through it. Like, the debt isn't bad as long as you, I don't know, have a strategy or a plan. It doesn't have to be something extravagant. You have a couple more doors and it gets more nuanced, but you're savvy in that field. But for the average everyday person, or for whatever your car debt, or maybe even your credit card debt, yeah, if you have a plan of attack, like, the debt, again, isn't bad.
Yeah, no, you're right. Because a lot of people don't have that plan like we're talking about, I think the catch-all is Dave Ramsey, and I think that's why he's so popular.
Yeah.
Because majority of the people don't know how to manage debt, don't have a plan to attack the debt. So in that situation, Dave Ramsey's your go-to guy.
Yeah.
And then I think at some point, you have it. It's like a weird saying, but like, do you have to graduate the school of Dave Ramsey? I mean, you don't have to. There's a lot of people that made it very successful by any means by paying off their debt, not having any debt, and they're multimillionaires, right? But at the same time, if you do learn how to manage that, and that's like add it to your skill set, it does become a little bit easier to grow And the more you know, the more likely you're going to graduate the school of Dave Ramsey and go into the other schools of financial thinking. But it's dangerous too, because you're trying to tell that to a 20-year-old. That's how they do it all, right? And you over leverage, over leverage, and you're like, oh God, I can't. Look, what am I gonna do?
Elaborate on when you say graduate from the school of Dave Ramsey. What is that? Is that a
Oh, okay, yeah, that's a good. Yeah. So like I said, you can be in the Dave Ramsey school of thought, right? Like no debt.
no debt?
The only thing you can do is a 15-year mortgage type of thing. You can go about your life, your entirety of your life going that way. But when I say graduate his school is, you kind of start thinking about, okay, I think I understand more and more about how money works. So let's look at the 30-year mortgage, for example. Like we walked through the math, right? But then let's talk about more of the economic side of things. Like if you look at any country, any other loan form, there's not a loan product that guarantees a same interest rate for 30 years. That is crazy. Like think about like your personal situation. Would you lend me money during 2020, 2021, when it was super low interest rates, right?
Yeah.
Would you lend me money at 3% for the next 30 years?
Right. No.
That would be crazy. Like I wouldn't even want to do. I mean, like hey, just at least put it in the stock market, right? But then you have 3% interest rate, and let's say you have a 30-year average inflation rate of 3%.
Yeah.
So your everyday dollar is getting devalued by 3%. So in that case, the money that you owe on this mortgage, even though the dollar value is relatively the same from year to year, like year one you owe 500, year two you might owe like 490.
Yeah. Right.
It's not that big of a difference, but when you compound that over 30 years, like the 500 that you owe today may not seem that much in terms of value in 30 years. A great example is like, we talked about the minimum wage, and we, in that conversation, we talked about how the minimum wage used to be 50 cents. You're like 50 cents. Yeah, that's crazy. But then like 50 cents got you a lot more stuff than today.
Right.
Yeah,
I love the 1900s. Yeah.
Yeah. It's like, and even if you're like 20, how much prices cost now, and then pre-COVID, it's drastically different. So in terms like stuff like that, that's a one example of understanding more of how money actually works, and you can take advantage of that, right? Like with that, with gaming the inflation versus interest rate, the theory would be, hey, get the most amount of debt so your debt becomes worthless while you own the asset.
Yeah.
Asset's going to go up with inflation.
Yeah.
So that's like one form of school of thought. And also, there's a school thing. You can get into arbitrage stuff that we talked about, right? Awake, they talk about a lot with the life insurance stuff. I'm not going to get into it, but easy form of arbitrage was like, hey, Jillian, let me borrow respectable 6% return annually. I'll pay you back in 2 years.
Yeah.
You're like, okay, I trust my buddy. I'll lend you money at 6%. And then I go to a flipper, be like, hey, I can give you 2%, or I can give you a 2-year loan at 12% because that's what they would pay. And then you can arbitrage that 6%. That's understanding how money works using debt. I'm not saying to go do that, but I'm just giving out examples of, there's more to understanding how the money works, which in turn allows you to quote unquote graduate from the school of thought from Dave Ramsey. And I mean, think about it. The U.S. economy runs on debt.
Yes.
Like know the fractional banking. Have you heard of that?
I have heard of it. I mean, I wouldn't be able to teach it to anybody, which means I don't have a thorough understanding. I've heard of it. I don't.
Yeah. The fractional banking system is how, like, pretty much all of the banks work. And basically what it says is that the Fed or a governing agency tells you, hey, let's say you're at a bank, right?
Yeah.
I give you $100 as a deposit.
Mhm.
So I don't have the $100 anymore. You have the $100, but then I have a promissory note in forms of a bank account that says, hey, I have $100
Right.
available to me, right? And as a bank, $100 is an asset to me, right?
Yeah.
Because that's the money that I'm supposed to have. But for a bank, for you, the $100 is a liability because when you hold that $100, you owe that $100,
Right.
right? So that's liability, right? And for a bank, how the business model of a bank works is now I get the $100, and now I can go lend that $100 out.
Right.
You know,
Whatever.
I get a personal loan it's probably ranging around low double digit, like 12%, right? And then now if you have to pay 1% to my savings account and you're collecting 12, then you're arbitraging the 11%. That's how the bank works. And then the fractional reserve banking comes in where like a governing agency dictates, hey, I think it's a Fed, but I could be wrong. But this agency says, hey, banks, you have to hold
That's
like certain amount and percentage of in your reserve,
right. So you
right?
can pay people. Yeah.
So let's say I give you $100 as a deposit,
Mm-hmm.
and then the Fed says you have to keep 10% of all deposits and you cannot lend that out. And you say, okay, so I'll lend out $90,
Right.
right? So what if I go to you and say, hey, can I borrow money? Say, sure. You give me $90. If you think about that transaction, you know, so I think I owe, or I think I own $100,
Yes.
right? So if you took your liability and my assets, only $100, right?
Yeah.
But then now you created additional $90
Right.
from the $100 that you have in forms of a loan. So to make it easier, let's say you lend it out to a person C. So the person C owes $90 to the bank. You owe me $100 in the bank, or from the bank to me. So in circulation, there's $190
Yeah.
from the original $100 that I gave you. But then now with that $90, he puts it into bank again.
Right.
And then you say, okay, I can lend out $81 now because 10% is $9 from 90. So subtract 90 is 81. And then now you take 81 and that goes on forever.
Yep.
And the original $100 expands like crazy. And that's why money moves around so much in the in a fractional banking system. That's the system that we run on. So if you think about it, the entirety of the U.S. government and U.S. economy runs on debt,
Yeah.
right? I'm not saying that's good or bad.
That's just how it works.
Thinking about government spending, it's probably bad because they're so inefficient. But if you take that portion out of the equation, you know, that's not good or bad. But I just wanted to point out it's crazy. This is how this banking stuff works.
Damn, that's a phenomenal breakdown. I feel like we need a whiteboard on here.
Oh yeah. I'm pretty sure I did a poor job explaining it, but it would be good to have like an expert in this field to just talk about.
Oh yeah, we don't get there. Yeah. No, that's good. I don't even know where to go to follow that. It's just, I mean this is why I think the conversation is good because like I heard of fractional banking, but it takes the homie to like break it down and explain it to me.
Mhm.
And even if I might know how it works, like can't put the term to it, but I feel those are the little seeds to even in the debt conversation of what is leveraging debt, and then once you know that, how to not over leverage, and um how to look at interest rates to know, I don't know, variable interest rates versus fixed or APR, or like just the little stuff to know where you get into. And we talked earlier about like debt traps or predatory lenders, which probably go after certain demographics, right? I'm in the military and it's a thing that young, in the Navy, call them sailors, like sailors. There are lenders that target them because they're in this new profession where they have like a stable income, and you might find a certain lender like near a base or somewhere. I don't know, they'll try to if they know if a car dealership knows they're getting an influx of sailors, they know they might be able to give a different narrative on how they lend to this certain demographic. So it's, I don't know, it all, I mean, it's all really just comes down to education at a fundamental level. But I just love the breakdowns you get that tie like tangentially tie into this conversation that I think are super relevant.
Yeah, and I feel like everyone knows that one guy that got like a 26% interest on the
Some
cars. That's
crazy. Yeah,
like I know a guy, like, I think he bought a used car. I don't know him directly. He used to uh he used to be really good friends with one of my buddies. So I'm not directly friends with him, but like
yeah,
I've
yeah,
talked to
yeah.
him a couple of times.
Right.
But yeah, like my buddy told me, he bought like a $12,000 car or something like that, right? So like it's something used, and he was paying like 400 something bucks a month. And I was like, wait, what? Because when I first bought my car, the car that I bought, I think it was like $25,000 or $26,000. Like I bought it brand new, and I put $0 down. And with whatever I got, my payment was like $410, like 409 or something like that.
Yeah.
And when he told me, he's like, he bought a
Like,
$12,000 car,
pay for half the
and
price.
his payment was more than mine.
Did he put
It
down?
was like, huh?
Did he put down?
I don't know.
Yeah. But even still,
But
yeah.
I'm like, how is that possible? So I don't know the exact, like, I'm sure I can figure it out if I typed it in a calculator multiple times to trial and error, but I know that his interest rate was like 25 or 26% or something crazy like that. And obviously, I mean, I'm sure his repayment plan was like relatively quickly, maybe like 3 or 4 years or maybe 5 years or something like that. But yeah, I feel like everyone knows that guy, and it just sucks because they take advantage of these people that
Yeah.
don't know too much about the personal finance, and they're trying to sell them. I don't want to say buying a used car is like a dream, but they're trying to sell them that dopamine hit of shopping around for like a new car or whatever the purchase may be.
Yeah.
And it's sad, and it's so predatory, like you said. I don't know how they sleep at night knowing that they pretty much scam people. And
I don't care, bro. As long as they're making their money, they don't care.
yeah.
All right, what else we got? I mean, we kind of we touched about it on the I don't want to say non-tangible effects, but like from a standpoint of that being good, right? We talked about the actual fiscal benefits if you use it correctly, but I guess it go in, and you mentioned it early on in this episode. I guess this would go in like a mindset benefit, but just the practice of continually making your payments on time, I guess, to build the habit or the discipline rather, is another good way. And I mean, as an adult, I'm sure you would have bills, or you'd have plenty of ways to practice financial discipline. I wouldn't recommend somebody like go into debt just so you can stretch the muscle of paying it off, but yeah, like absolutely not. But that is one way to just practice a good habit that when you expand or your portfolio expands or you get these larger amounts of debt, you're either comfortable with tackling it or you're used to paying it off in a timely manner. And conversely, like if you just kind of lackadaisical about it and you're in debt and when you make your payments at the end of the month, first of the month, whatever it is, and you don't like I alluded to that cycle, that negative like spiral. That's how you get into that negative cycle when debt does become bad. As we stated, like consumer debt already is, as you stated, I think agreed upon that is bad, but it's worse when you don't pay it off. And that's how it becomes like compounding in a negative way, which obviously we all want to avoid.
Yeah, I think the habit piece is so important. I know you brought it up, and I'm glad you did because it doesn't just affect you, right? I think I initially thought of my, I guess, journey in personal finance or investing or whatever you call it, whatever you call it, money wise. Like I didn't have a family member that I could go to look for investment advice. right? Like both of my sides of family, like they do, like they're both in either the lower middle class or upper middle class. And I think we generally, both sides of my family grew up on the traditional notion of, you know, debt's bad. But even though we use that debt's bad type of mentality that I think majority of the middle class is in. And I was like, like I'm gonna grow older, I'm gonna gain wisdom, and I want to be that guy within the family that can talk about a lot of investment stuff because
Yeah.
I just didn't have a mentor like that, and then all my mentors were authors that I read books on, and I can't even, they cover a lot of good stuff, but I can't even ask them questions.
Right.
And then
That's
you know
real.
you, um, so it's like I say, it doesn't affect you, like especially if you have kids, like you said in the beginning of the podcast, dude, like money is never gonna go away.
You know.
Regardless of we go to fiat current, like we stay in fiat currency, we use cryptocurrency, or we go back to using seashells. Money is always going to be there. So what a better way for you to start learning about money, practicing the financial habit that you were talking about, that's going to only bring you happiness. It's going to only bring you benefits, regardless of how you use debt. I guess this is the debt topic,
Yeah.
but aside from debt, regardless of how you use it, good or bad, like, the more you learn about it, the more you can practice that habit in your daily life.
Yeah.
And on top of that, the greatest thing is you can pass it on to the next generation. Your kid, maybe your kid can turn or start teaching to their kids. And yeah, I mean, just fostering that,
Yeah, yeah, yeah.
you know, ah,
Dude, yeah.
it will be open enough to talk about money. Cause I mean, think about it, dude. There's no way this whole predatory, gambling, bad financial habits is not going to get spread around with social media,
Yeah.
right? Like we were talking about on the side. I think we talked about, last couple of episodes ago, how I'm starting to see a lot of ads about.
Yeah.
They're like, "Hey, like you can get these a super quick cash with
Yeah.
no application,
No
super
strings
quick, your deposit, no strings attached," and like, it's like, "Oh, finally I can pay my rent." Like those I start seeing them a lot. I start seeing a lot of scams, like crypto scams. I start seeing a lot of stock scams. I start seeing a lot of, these education courses, like gurus that like you have to pay $4,000 to get in, but that you don't really see any results. That's not gonna become less. It's gonna only become more and more. So you gotta build that like shield of not taking in all this like BS money stuff, and then start practicing actual good habits of, I guess financial responsibility or management or whatever you want to call it.
Dude, absolutely. I was trying to look. Didn't we do I don't oh yeah, yeah. The get rich quick schemes episode. Yeah. We we talked about
We did.
a lot about that. I was like, I know we're doing, yeah, I was trying to look at it. That was our 20th episode, yeah. Um and then we highlighted a couple episodes ago, just very predatory in nature, but so not to get sidetracked. I love how you put that and just tied it into kind of how you can pass it down, like that knowledge piece. And if you learn how to handle debt or leverage it correctly and implement that larger scale beyond just yourself and your household or generationally, that's another thing we talk about, the generational wealth piece. And again, whether you're passing down physical assets or you're passing down or business or passing down the knowledge, um how awesome would that be to just acquire that? And I love how you want to be that face for your current and future family. I gotta tip my hat to you, bro. I think that's awesome. But and I think you just found your motive and within this space that kind of drives you. Whereas everybody doesn't, and people's interests are different. Some people aren't financially driven, or just don't care as much, which is totally okay. And our reason for this is really just to foster the conversation, to go against what may traditionally be said, or that might be outdated. Maybe it was true once, but it's less true now. And to bring the conversation full circle, I think that might be why you said, at some point in our young lives, our young adult lives, you might surpass your parents in knowledge. It's because as society advances, the way, I don't not banking, but there's like or fiscal strategies. I don't like the way money is used. That also changes. We also had an episode not so long ago about crypto and how there's a country that fully adopted crypto as a currency, or how crypto might be involved in the future. Uh, my 60-plus-year-old parents don't aren't they didn't grow up on crypto. They don't know, or they don't even care about it because they don't have that connection to it. It's a novelty thing to them. It's like it's not real. But with us growing up in it and seeing like how it's affecting Donald Trump, the president, talking about using it or using it as a reserve, or like I just stated, seeing a country that adopts it, and then the generations after us that they're gonna grow up here from the start hearing about crypto. Yeah, they're gonna know more about it and they're gonna learn about it. And so as the times change and we grow up in these different eras, as you said, the knowledge might come from the bottom up. But it just, if we stay thirsty to learn and stay open minded, I don't know. I think that's the best approach. I kind of went on a tangent, but yeah,
No, it's good. I love the dude.
yeah, dope. All right. Got any closing thoughts on debt?
No, I think you wrapped it up very good. Like I said, I mean, at least a wrap up. Anything that you hear about, like I'm sure 99% of the things that you hear about for any strategy is good nor bad, right? But then when you kind of have a deep look into it, somewhere down the middle of the two extremes is probably not, I guess, like I said, not right or wrong, but on a better path than the extreme. And I think conversation of debt, it definitely falls, you know, is it good to live 100% on debt? No, I don't think so. Is it good to not have any debt? Okay, I can say that it's good, but I think a better way would be to minimize debt while using debt properly to, you know,
Yeah.
grow your net worth
Yeah.
or accumulate assets and not spending it on dumb stuff. So,
If I could twist what you said slightly, continue to say, I like how you said that. If I had to choose 100% debt or no debt, yeah, hands down, I'm choosing no debt. But within the realm of no debt, I think you are stifling or capping your rate of growth monetarily. You can grow more and faster with debt, but if I had to choose an extreme, I would choose no debt. So on that, and to your point B, I think for any individual, the best case scenario is somewhere in the middle, and it's personalized. It's tailored to you. What are your ambitions? What are your goals? And you can your debt you will use or incur debt accordingly. But I wouldn't say go all in on debt, and I wouldn't say avoid it. Find your happy middle. Dope. All right, that's it from us on debt. If you have some unique strategies, like let us know, hit us up in the comments. But until next week, that's all we got for you.